Merger arbitrage is a hedge fund strategy, sometimes also referred to as risk arbitrage, that aims to profit from predictable moves in stock prices that occur once a merger deal has been announced. It's an absolute return strategy, which means that it aims to make money whether the overall market rises or falls. It's a trading strategy that's been around for quite a long time. Benjamin Graham even wrote about it in his 1949 book, The Intelligent Investor, which many people consider the Bible of value investing. In today's video, we're going to talk about how the strategy works. I'll explain the difference between a cash deal and a share-for-share deal, and we'll talk about the risks of the strategy, and at the end of the video, we'll look at the returns to merger arbitrageurs over time. When a merger is announced, one company that we call the acquirer bids to buy a company that we refer to as the target company. The price offered is usually higher than the target's unaffected share price before the bid. So let's make up an example. Let's say that Apple decides to buy Spotify for $380 a share. Now, Spotify's recent high stock price from about a week or two ago was around $290 a share. And so Apple would be paying a premium of a bit over 30% for Spotify. What you would expect to see is Spotify's share price almost instantly rise to a price that's close to but a little bit below $380 per share. So let's say, for example, that Spotify shares rise quickly to $370 a share, which is $10 below the bid price. The difference between the takeover offer price and the unaffected share price is what we call the deal premium or the takeover premium. The offer terms can be in cash, like $380 a share, or it could be a stock deal where one share of Spotify is exchanged for 3.5 shares of Apple stock. Now, 3.5 shares of Apple is worth around $380, so essentially it becomes roughly the same. So in our example, the deal premium is just over 30%. In the research done when writing the corporate finance book that this video is based upon, we found that the average deal premium was 37%. For smaller companies with market caps below $100 million, premiums were around 50%, so there's bigger premiums for smaller companies. So why did the shares only jump to $370 per share rather than the $380 that we know that Apple would be paying for Spotify? Well, this discount to the offer price reflects the time value of money as well as the market's uncertainty about how likely the deal is to go through. Now, of course, the deal isn't going to close in like a day or two. It's going to take months to close. So obviously $380 a share, or $380 today is not the same as $380 in a few months' time. And also there is, of course, some risk that the deal won't get done. Now, the greater the risks to the deal closing, the larger you'd expect this discount to be. The difference between these two prices is what we call the arbitrage spread. In the investment world, there are specialist investors who aim to profit from this difference, and we call those risk arbitrage traders or merger arbitrage traders. If the merger is completed, they earn the arbitrage spread. They earn that $10 that we just mentioned. But if the merger fails, they could suffer a substantial loss, as the target stock price could fall back to its previous trading price and possibly even lower, because maybe it failed because some very bad news came out about the company and it's sort of permanently impaired. So that is the risk in this trade. Now, merger arbitrage hedge funds trade primarily announced merger transactions, and this means that they capture that final $10 profit that's left on the table after the deal has been announced. So these funds don't capture the big price jump. They don't catch the jump from $290 all the way to $380 in our example. Instead, they step in at $370 and capture the move from $370 to $380 a share. Often a target stock can move up 25 to 35% upon announcement, leaving a 1 to 3% discount to the merger terms. The size of the spread that remains after a deal's announcement reflects the risk of investing in the deal. Investors who trade merger arbitrage strategies are generally experts at evaluating these risks, and they're able to quickly decide which deals offer sufficient returns given the risks. A lot of the people who trade merger arbitrage are ex-M&A bankers or ex-M&A lawyers, basically people with a lot of expertise in this space. As you can imagine, investors who successfully identify good takeover targets stand to generate significant returns. Where overall equity markets over very long periods of time generate returns of 9 to 10% a year, takeover announcements frequently boost the stock price by 30% or more in a single day. And so as a result, an awful lot of people aim to pre-identify potential takeover targets, and then they attempt to compile portfolios on this basis alone. Now, this is not merger arbitrage, and this approach is not usually the focus of merger arbitrage traders, because they're not looking for that huge pop that might be risky. They're looking to capture the low risk, small move that's very predictable. Now, in most parts of the world, insider trading is obviously illegal, and regulators pay a ton of attention to large trades that occur just leading up to a merger announcement. A famous merger arbitrage trader who was caught trading on insider information was Ivan Boesky, and he was sent to prison for 2 years and fined $100 million and banned from the securities industry. So obviously, regulators are looking out for this sort of thing. Okay, so back to our deal. In a cash deal, the acquirer offers to purchase the shares of the target for a certain price, all in cash. And the target stock price then jumps to a price a little bit below the offer. Now, it's worth noting that in some more unusual cases, the target stock price will actually rise above the buyer's offer price and trade at a premium to the deal's offering terms. And what this indicates is that investors expect another buyer to emerge offering a higher price for the target. So this occurs in cases when essentially people feel that the terms being offered are too low. So to trade a cash deal, it's fairly simple. The arbitrager will simply buy the target stock. So based upon our example, you'll just buy Spotify shares for $370 a share. And then when the deal closes, they'll get $380 per share from Apple. The share price won't really move around an awful lot based on general market rises and falls, because really all of the risk in the stock is now just about whether this deal will close or not. So it'll rise and fall a little bit based on the probability of the deal either closing or breaking. Now, some merger arb traders will try to add to their position or cut some of the size if they feel that the price doesn't accurately reflect the risk of the deal. Now, many factors determine how wide or how risky the spread is. One is the probability of the deal breaking. Two is whether the target company is paying a dividend or not before the deal closes. Number three is the probability of a higher bid coming in. Number four is whether the deal is hostile or friendly. Number five is a shareholder vote required for the deal to close? Obviously, if one is required, it's a little bit riskier. Number six is the buyer a strategic buyer or a private equity buyer? A strategic buyer is usually more committed to closing the deal than a private equity buyer would be. Number seven, we've got how long will it take for the deal to close. At number eight, we've got the downside. So if the deal breaks, how much can the target be expected to fall in such a scenario? And last, at number nine, we've got the tax implications of the deal, which of course will matter a lot to arbitrage traders. So all of the calculations of the deal spreads, implied probabilities of a deal break, and so on can be found in the corporate finance book, and I'll put a link to that in the description below for people who are really interested in this. Now, as I mentioned earlier, the other type of deal is a stock deal, where Apple, instead of offering cash, offers to purchase the target by exchanging its own stock for the target stock at an agreed upon ratio. I think we said 3.5 shares of Apple for each share of Spotify. So stock deals are a little bit more complicated than cash deals, simply because there are a number of additional things that can happen in this type of deal. For example, in a stock deal, it might be difficult to borrow the shares of the acquirer, which are needed in order to short the stock. stock, or there could even be a takeover offer made for the acquiring company, Apple, while the deal is in play. A lot of the risk factors relate to the risks of shorting a stock, and I'll probably put up a video in the next week or so explaining how short selling works. So anyhow, additional risk factors in a stock-for-stock deal include the need for a vote from the acquirer shareholders to approve the deal. Also, the cost and availability of borrow on the acquirer's shares, and any acquirer stock dividends that a merger arbitrage investor will have to pay when short the stock. So to trade a stock deal, the arbitrager will buy the target stock, so they'll just buy Spotify shares, just like in the cash deal, but this time they have to short sell the acquirer, Apple's stock. The reason for this is that they're not going to be receiving cash when the deal closes. They'll be receiving shares in the acquiring company, and of course those shares can be going up or down, so you need to be short that in order to lock in the price difference between the two. So for each share of Spotify that you buy, you'll need to sell 3.5 shares of Apple short. Now, the size of the spread will relate to the market's perceived risk that the deal will break or not complete on its originally announced terms. Merger arb investors profit when the spreads narrow, which occurs when the probability of the deal closing increases. Upon deal completion, the target stock will be converted into stock of the acquirer based upon the exchange ratio determined by the merger agreement. So at this point, the spread will close. The investor uses the converted stock to deliver and to close out their short position. So in our example, we were short 3.5 shares of Apple for each share of Spotify that we owned. At deal completion, the Spotify shares disappear and each one is replaced with 3.5 shares of Apple, which will automatically cover or close out our short position. We're left with the $10 profit per share. The profit is the price spread from when you initiated the trade. So when you're trading this deal, the long position in the target and the short position in the acquirer stock must be traded together like a package in order to capture the deal spread or the arbitrage spread. A lot of professional trading apps have spread trading algos that allow you to trade the pairs without running the risk of having a position in one but not yet getting filled in your position in the other and being exposed to market risk. In stock deals, it's important to take the cost of borrow on the stock that you're selling short into account when calculating your profitability. In many cases, the cost of borrow is around 0.5% per year. These are shares that are referred to as GC or general collateral on the shares that are sold short, but this will vary from stock to stock. Sometimes on special names, the cost of borrow can be over 8% annualized. Spread trading outcomes are obviously much more complex than the cash transactions. There can be takeover offers for the acquirer's stock, which merger arb traders hold short positions in once they're invested in a deal. There can be counter bids at higher prices to the takeover target company, depending on the likelihood of the first or second bid on the target being successful. So the spread from the initial deal can behave unexpectedly, as there can be material trading in both the acquirer and target stocks around reconfigured market expectations. Another complication is the cost of borrow for the acquirer's stock. When this is too high, the deal can become uninvestable or too costly to invest in and still earn a profit. And I'll explain more of that in my upcoming video on shorting stocks. So how do we compare spreads on various deals? Well, since deals close over various time frames, with many cash deals closing in under a year and some deals taking well over a year to close, traders can calculate annualized deal returns to compare different deals. So if a deal gets extended long enough, its return can actually fall below your cost of capital, and you end up taking risk and getting a return below the risk-free rate, which is obviously unattractive. In practice, investors must be better compensated for investing in riskier deals than they are for less risky deals. If this wasn't the case, people would just avoid investing in the riskier spreads altogether. So you'd expect higher returns from riskier deals, but equally there is a greater risk of them breaking. Now, on an unlevered basis, merger arbitrage spreads can appear to offer quite low returns, but because of their lack of correlation to overall markets and due to the very high win rate, it's often around 80%, they can still be quite attractive to many investors. Merger arbitrage is usually operated on a portfolio basis, with a trader investing in often dozens of deals at a given point in time. The portfolio approach provides diversification benefits and smooths out overall returns. And if you'd like to learn more about the mathematics of diversification, I put up a video on that topic a couple of weeks ago, and I'll link to that below. In addition, the very low volatility of this strategy means that these portfolios are often run on a levered basis, often being levered 3 times or more in order to generate annualized returns of 20% a year. Now, the clean price of a stock is a measure of the break risk for merger arb traders. Since the upside is generally capped, a lot of focus goes into calculating the downside risk. A trader needs to estimate the price that the target stock might fall to in the event of a deal break. In practice, if a deal does break, the stock falls almost instantly, and things like stop loss orders just won't help you at all in situations like that. Now, when a deal does break, the target price falls to what we call its clean price, and this can mean an immediate drop of 25% or more. Clean price calculations are never exact figures. Often a good starting point is the closing price of the target stock the day before the deal was announced. The clean price might be below this if there were bid rumors or if the market has fallen sharply over the life of the deal. In situations where a deal gets dragged out and where market conditions have changed materially since the deal announcement, the initial clean price calculation can become unrealistic as a break price estimate, and traders will often look at the stock's beta from before the deal's announcement and make a calculation as to where the stock might now be trading had the deal never been announced. They will take into account things like how the target stock sector performed since the deal announcement. In sharply rising markets, this would mean beta adjusting the clean price upwards to reflect the fact that the overall market has moved upwards since the deal's announcement, and that this would likely have lifted the target stock price in the event that a deal had not been announced. So the clean price estimate in falling markets must acknowledge a lower anticipated floor for the stock should the deal break because of market or sector shifts downwards over that time frame. Calculating a probable break price is obviously more of an art than a science. So why does anyone sell their stock to a merger arbitrage trader? Well, the regular investor who's possibly owned the stock for a long time will have participated in the 30% or more stock price pop, and while they could hang on for another 2 or 3%, they're often just happy to walk away with healthy gains and let someone else take the risk of the deal breaking. Often they have no expertise in whether a deal will close or break, and they're just happy to lock in their rather significant gains. So factors that affect deal risk are things like the time to completion, whether it's a cash or a share for share deal, and the type of shareholders invested in the target stock. Obviously, if the shareholders are mostly index funds, there's less risk than if it's mostly owned by the company's founders or by, we'll say, an activist hedge fund or something like that, as these people might be opposed to the combination. Synergies announced and expected will also be analysed by merger arbitrageurs because unreasonable expectations could be considered a deal break risk, in particular if the acquirer shareholders think that realising those synergies is excessively optimistic or highly unlikely. Market performance and sector performance will matter as well. A good example of this is that in 2020, many deals that were announced before the coronavirus pandemic had problems as buyers sought to change the terms or simply walk away from the deals. Sycamore partners, who had announced that they were buying Victoria's Secret in February 2020, sought to exit the buyout by filing a lawsuit accusing the Victoria's Secret owner L Brands of improperly operating the retail company amid the pandemic. The deal stated that the seller had to run the business as normal up until deal completion. That's a sort of standard term. But what happened was the buyer argued that Victoria's Secret were not adequately staffing stores and were cancelling shipments of their goods. And of course, this was being done because the malls in which the stores were located had been closed. But Sycamore used this as an argument to get out of the deal, which no longer seemed attractive to them in the new market conditions. Buying a retail store at a price agreed upon in February 2020 just didn't seem as appealing by April of the year. The potential for a competing offer for a target company can be an upside risk for a merger arbitrager. However, an offer on the acquiring company in the middle of an announced deal in a share-for-share deal can be a very negative outcome for arbitrageurs because they're short that stock. Most deals above a certain size involving publicly traded companies require a filing with antitrust authorities. If the company does business internationally, they may deal with more than one antitrust authority. In the US, both the FTC, the Federal Trade Commission, and the Department of Justice review mergers. So our deal between Apple and Spotify might be quite a risky one, as there's a good chance that the FTC would reject it as being anti-competitive. Once the company's filed, the government has a certain amount of time to approve the transaction or to ask for more information if there's an antitrust issue. The authorities might send out a request for more information. Any additional requests mean an extended timeline, and that can materially affect the deal or even break it. I put up a video on antitrust law about a week ago that I'll link to in the description below if you're interested in that topic. Sometimes even foreign reviews can cause problems. In October 2000, Honeywell accepted a takeover bid from General Electric. The US regulator cleared the merger, but the European Commission blocked the deal. This was the first time that officials outside the US broke a merger between two American corporations already approved by the Department of Justice. So what do merger arb strategy returns look like? Well, academic research shows that this strategy, unlevered, outperforms the market by about 3% a year. A lot of hedge funds might then apply leverage and aim for returns of around 20% a year after fees. In flat or rising markets, merger arbitrage gives good returns, but it does tend to lose money when the market falls by 4% or more in a month. This makes sense simply because deals are more likely to break in a falling market than in a rising market. People just want to back out of them. Merger arbitrage thus has a similar payoff profile to being short put options on the S&P 500. There are a few ways that an investor can get access to these returns. Historically, this strategy was exclusively the domain of hedge funds, but it's become more accessible to investors via low-cost bank indexes and ETFs. This chart that you see up on the screen right now shows the returns over the last 10.5 years. As you can see, 2020 has been a bad year for the strategy, and of the three ways of investing in merger arbitrage, hedge funds, the green line, seem to have done a better job than bank indexes and ETFs. So it does look like these guys have added some value for the fees that they've charged. So be careful not to break the screen on your phone when you hit the like button, and if you'd like to see more content like this, do hit the subscribe button and the little bell next to it. There's a lot more information on this topic in my corporate finance book than would fit in a short video like this, and if you want to check it out on Amazon, I've put a link in the description below. See you later. Bye.